Hello, my friends. Welcome to another week of mortgage market updates with Helmer. And this week, our guest again is Joy Francisco. So, Joy, thanks for joining us again. Please go ahead, take a minute and reintroduce everybody on who you are, and then we'll get started.
Okay, y'all. I'm from Texas. My name is Joy Francisco. I have 5 kids, 4 dogs, married 18 years, was in the military. I mean, what else is there, right? 5 kids in my life.
There you go. You short and sweet. So
Yeah.
awesome. Well, thanks again for joining us today. We're going to talk about rates, the market, forecast. We got a lot to kind of cover. This whole thing will take about 20 minutes, y'all. If you're watching live, if you are here live, let us know in the comments. I do monitor those. Also, let us know your name and if you're a consumer or a mortgage professional, because I don't get to see that. I just see Facebook users. So let us know you're here. Let us know who you are and what you do. And if you're watching on the replay, I know many of you can't make it live, but you do watch the replay. Do us a favor, just give us hashtag replay in the comments. It lets Facebook know that you're watching. It lets us know that you're watching. And we appreciate that as well. And if you've got any questions or comments, go ahead and just post them out there and we will be glad to address them, whether you're here live or if they come up later in the week and you're watching on the replay, just post them in the Facebook threads and we'll be glad to answer them there. So with no further ado, let's do a quick rate recap. Let's talk about what happened to rates since last week when we talked about this. If y'all remember last week, rates had moved a little bit higher. We'd seen a lot of VA rates were in the high fives. They've kind of pushed up into the low sixes as an overall. Just again, this is not an offer to lend, and your unique situation will depend on your credit score and other variables. So you should always talk to a vetted VA pro if you're looking to get some advice or information. But as an overall general idea, we were in the high fives. It moved up into the lower sixes for a VA loan. If you're not getting a VA mortgage for any reason and you were looking at what's called conventional conforming rates, or the kind of normal rates that everybody, the public, John Q. Public sees, those were in the mid sixes at this point. And that's kind of the higher side of where we've seen rates over the last couple of months. In fact, there's a wonderful article here. Let's see, I'll pop this up on the screen for y'all. Here's a nice article from Bloomberg, and it talks about how the U.S. 30-year fixed mortgage rate climbed to a 6 high. Now, this article came out today. The nice thing is that this is old news. It's not fake news. It's just old news. So you don't have to worry about it. We actually are seeing things come back down again. So if we were to recap where things are since last week, the end of last week, we kind of hit that high point. This week, Monday, markets are closed because of the observance of New Year's. And then Tuesday and today, though, we have seen rates kind of improve a little bit. That's what I've seen, kind of a national average. Joy, what have you seen in your market?
So I'm in Texas, and I always go by the consumerfinance.gov website to see where I am in terms of the national average. So I'm going to go in and I'm going to click on choose your state, Texas. Now, housing prices, it says here like 200,000, guys. That's not realistic in a lot of markets in Texas. So I put 300,000. Down payment 0 because I'm going to go to a VA loan, fixed rate type of 30 years. And you want to make sure you click VA. And what that does is it gives you kind of a running average of what most, now this is banks, this is brokers, this is all kinds of lenders, and they're giving right now a 6.563. That's the average. But here's the assumption. The assumption is you have above a 700 credit score, you're putting 0 down between 700 and 719. Also, what you don't see, it's in the fine print, they're adding 1 point, 1 discount point on this as well. And then it gives you some great tools. So I always love going to this site and a half a point, negative 0.5 to 0.5 in discount points. Sorry, not 1 point. So there you go. It assumes, though, that some people could be charging for this rate, or some people could be giving you a little bit of a credit for this rate. Again, check with the vetted mortgage professional to see what is offered in your area for your situation. There's 27 different factors that goes into interest rates, but I love looking at this to see where I am personally on the national average, to see what's being offered, and to also educate consumers, because it's a great tool with no solicitation, right?
I got to tell you, though, so Joy brought this to my attention today. I haven't really looked at it. I did remember that it's there, but this tool, just to be frank, I think it's kind of stinky. look, now I know why everybody is coming here for help, because when you look at this, this is telling us, well, one lender's offering 5.25%. This one's offering 7.75%. Then it's telling us, well, they may charge you a half a point, or they may give you a rebate of a half a point. Or so this kind of really, this really, in my opinion, like I could see, Joy, where you want to see where you land on this. But if I'm a consumer, this is about as useful as, well, to be Texan, tits on a bull. So
Right.
I don't find this to be very useful. So I will, we're going to turn that screen back off and tell y'all. So yeah, what do you see? What kind of rates do you see in Texas that you're able to offer your veteran, borrowers today?
Low sixes, depending on credit score, loan amount. The lower the loan amount, the higher the interest rate can be a little bit, because it's sad, you're not borrowing enough, right? And then if you get too high, right, you get a little bit of a hit on that as well. So low sixes for a good credit, what is it, a loan amount of 300, over 300, things like that. But the interesting thing is that that little tool, a lot of people don't even understand what could be offered. And guess what? That 5.25, I want to know how expensive that is.
Right.
How expensive is it? Right. That's why Helmer is saying that this isn't a great tool, because it doesn't show the cost. That is costing more than 0.5 in discount points. I guarantee it.
And if anyone's giving you a rate of 7.75, you definitely want to be shopping around.
What if your score is at 500 though, Helmer, and your loan amount is 150?
I didn't say that. I didn't say that they may not be able to do better than 7.75. I just said, as Christopher Griffith would tell them, shop around. Make sure that you are comparing quotes, and that's not a single lender giving you that rate quote. If you get it from 2 or 3 different sources, well, then, and they can explain to you why, well, then that's your rate. You got to work with that. But I would definitely be getting a second opinion if that was the quote that I was offered. So
you should do that. You should do that in any case, though. At least get 2 quotes.
Yep. Shopping around is definitely important. So let's talk a little bit about our rate forecast. Where do we think rates are going from here? So overall, I think rates are on the mend. I think they've lost ground the last couple of weeks. I had said to y'all over the last couple of weeks, the markets tend to take the end of the year off. Traders take the end of the year off. What happens is we see very low trading volumes, and that can exaggerate the rate market. We saw rates go from the VA rates, so go from the high 5s into the low 6s. Conventional rates went from the low 6s to the mid 6s. So now I think we're seeing things kind of return back to that low 6, possibly even into the 5s for those VA rates. A couple of things that we'll talk about today that are affecting rates and what they want to keep an eye out for. But I think rates overall, if you're out there house hunting, this is a good week to feel a little more assured that you don't have to worry about rates creeping up behind you while you're out there looking. And if you have found a house, it's a great time to talk to a mortgage professional and decide when you want to lock in those rates or what a good rate to lock in is. But I do think we'll see things get a little bit better from here and improve from here. And I'll talk about why in a minute. What do you think, Joy?
I'm waiting for February. I want that recession label to come out. CPI data is going to come out and be better. And, it's getting a little scary in some things like stocks and things like that, but recessions are really good for mortgage rates, and they're usually really good for real estate. So that's what I'm looking forward to. And I told everyone, now I don't have a magic ball, but I perceive that's my educated guess.
Yeah. So everybody, let's go a little bit deeper to the education side of why rates move and why we think rates could improve, through this year, as well as even over this week and next week. So I'm going to go ahead and bring up my screen and show you guys some stuff we've talked about before. If this is your first time seeing it, I'll explain it. If you've seen it before, this will all be familiar to you. But this is what we call a Fed Watch tool. And this is basically how markets are currently anticipating the Fed is going to act over the next few Fed meetings all the way through the rest of this year. And this is important because they actually trade what are called Fed futures, and they're betting on where the Fed is going to be. So as the Fed raises the interest rates, that's going to cause mortgage rates to creep higher, but it doesn't happen at the same time. The anticipation or speculation that the Fed will raise rates in March or in May is actually something you'll see hit mortgage rates today and now. So it's we see the activity before it happens. So right now the Fed is expected to take that Fed funds rate, their policy rate, from 4.25 and raise it by 0.25% at the end of this month to 4.5. And that's a 70% likelihood that we're going to see that happen. There's about a 30% belief that we could see that go a little bit higher and they could do a 0.5 point rate hike and raise that rate up to 4.75. But right now the consensus is a little more to the side of 4.5. Then we're going to see in March at the next meeting, it's about 6 weeks later, we're going to see the expectation that the Fed will raise rates another 0.25%, and that'll bring us up to 4.75. And there's some expectation that by then we will be to 5%. What's important to note, though, is we're not looking above 5% in March. And that's key, because if the markets start to anticipate that the Fed is going to have to be more aggressive and raise rates past 5%, well, that's going to cause mortgage rates to creep higher now. And as we go into May and June, and I'm going to click through some of these other meetings, we're going to see that rates are expected to cap out either at 4.75 with a close second guess of 5%. And then by June, same thing, 4.75 to 5%. And July, they're supposed to hold there 4.75, possibly still at that 5%. And then as we get later in the year, they're expecting those rates, you can see now, that 4.75 is much higher. 5% gets to be quite a bit lower. As we get to November, 5% starts to really disappear. And they start to expect that the Fed is going to need to go ahead and start reducing that Fed funds rate towards the end of this year. And that's because, as Joy said, we'll probably be in a bit of a recession. So what the Fed is doing is raising rates now to slow the economy down. That is expected that is very likely to cause some kind of a recession. And right now, a lot of the speculation is it will be a shallow recession, that it shouldn't be too bad. But this week we have jobs data coming up on Friday, and that's going to be the only jobs report that we get before the Fed meeting at the end of this month. So Joy, when we get the jobs rating, have you done any research into what you think we'll see on that jobs report? Do you think it'll be better or worse for the labor market?
I think we're going to have fewer jobs. I mean, that's the bottom line.
Yeah. And if we do see that right now, the Fed is worried that the labor market, and especially wages, that's going to cause more inflation. So what happens when people are making more money? We want everybody to make more money. We want wages to go up. That sounds great. But the downside to that is that when you have more money, that can increase demand, and then that increases inflation. So when people have more money to spend and they spend it, it drives the cost of goods up. So that's going to be inflationary. We're hoping to see inflation start to move down. We're hoping that we've seen it plateau. By the way, one of the reasons you're seeing rates improve today is that inflation reports overseas in Germany and in France also showing inflation starting to slow down overseas. So we've actually seen inflation slowing down here on the last two reports. It's still much higher than we want it to be, but it is slowing down. And then we've seen it slowing down overseas in the other markets that kind of affect our markets over in Europe. So all of that is helping us to see mortgage rates here level off, stabilize, and hopefully as we move further into the year, they'll start to come back down and we'll see the 5s, maybe even the 4s, depending on where the economy goes. One thing that we should really be clear, though, if we see rates in the 3s and the 2s again, it means that we are in a world of trouble. So don't expect to see rates go back down to these pandemic lows that we saw. That truly was a catastrophic, hopefully, once in a lifetime event caused by the pandemic, the lockdowns, all the other, economic fallout, if you will. So but rates in the 4s before the pandemic. I bought my house 2017. My rate was 4 1/8. So, we did see rates in the 4s back before the pandemic. And that's ideally by 2024, maybe we'll see rates will be in the 4s again. And that would be a very good spot for the economy to be. What do you think, Joy?
So I've been reading a lot on the issues in Ukraine and with Europe and inflation and the energy struggle, because they get a lot of their energy sources from Russia and all that. So some countries, I believe it's Poland, 17.1% inflation.
Right, but
It's huge.
but they also will look at a core inflation, which pulls out those energy. So they pull out energy and food costs. So they expect that to, yes, you're right. Overall inflation can be higher, but they're still looking at that core inflation, which reduces out the energy. Because you're right, that whole situation in Ukraine between wheat and food issues and then energy issues can cause inflation to be higher overseas right now.
Yeah. So I mean, I've read that, and I'm just ready for things to stabilize because I still don't think we're, at a stable place in our markets. Like you said, I'm looking for 2024. 2023 should be great towards the end, right? Mid even. And it's getting better. It's not what it was August, September, October of this year. So that's great. But there's still what if the Fed changes their mind? Right? What if they don't? Do you think they're really going to hike interest rates to 5? What is your personal opinion?
I think that we will see 5. The markets are currently pricing in 4.75, so they're pricing in 2 more quarter point increases. If we see a quarter point increase in February, we see a quarter point increase in March, and if we've seen, like you said, you mentioned the CPI inflation data. The Fed monitors the PCE inflation, the personal consumption expenditure. For those that don't know, there's 2 different inflation reports for consumer inflation. There's the consumer price index and then the personal consumption expenditure. And the Fed chooses to kind of go with the PCE. The CPI tends to come out first, though, and we really can see where inflation is going from that report. So if we see inflation is in the bag, if the labor market slows down a bit, 4.75 would be our peak or terminal Fed funds rate. We'll see things stop there. If not, I think that they would do another, rate hike in June, but I probably stick to quarter point hikes as long as we see a quarter point hike in February. If we see a half a point hike in February, then I think that we'll see 5 in March because I think they will end on a quarter point rate hike. Today we get what's called the Fed meeting minutes, by the way, for those of you that don't know, at 2 p.m. Eastern time. We're going to get the minutes from last month's meeting. Last month's meeting was a big meeting because we saw forecasts, or what they call the dot plot. We saw forecasts where Fed members said that they thought rates were going to go as high as in the mid 5s, and the markets are just not pricing that in. Markets just don't think that's going to happen. They don't think the Fed is going to have to be that aggressive. The Fed is forecasting a little kind of behind the lag, if you will. They're thinking they're going to have to go that high, and they're not really paying attention to what's happening right now. And I think that's true. So that's my take on it.
Well, yeah, and their data lags, right? But the CPI, and I know they go by the other one, but the CPI has already shown that what they're doing is working.
Yeah.
It's not going higher.
Yeah, we've gotten 2 months in a row where it has come down, but it was still above 6%, for that. So they want to see that down around 2%, whether they use the PCE or the CPI. That's generally where you want to see inflation.
And that's why we're going into a recession, y'all.
Yep, because they got to slow it all down and stop the spending.
Screwed it up in the first place. Sorry, I'll stop.
Yeah, no. Well, the Fed, the Fed did say last year that they expected inflation to be transitory, and that they thought that it was more from supply chain issues. It was almost like they were ignoring the fact that we put trillions of dollars into the economy and hadn't accounted for that.
40% more money. 40%, y'all. So this was a self-made recession. Most are.
Yeah, I was going to say where we're going into it, and the inflation and everything that we're feeling, and the cost at the food store was something that was created because of all that money that went into the pot. So, for the right reasons, good intention, poor execution.
Yeah, I'm from the government, and I'm here to help. Those are scary words.
So for those of you, Facebook user said, how do we get the replay when the live is done? It'll live inside of Facebook. I believe it's also on the YouTube channel. Do I see him on YouTube up here? Yeah, he's got it on YouTube. So it'll be on YouTube as well. So if you go to the Vetted VA group on Facebook, you'll be able to just find this post in there. If you go on YouTube, on the Vetted VA YouTube channel, you'll be able to find it there as well. Welcome to Thomas Sloan. Glad to have you here, sir. Thanks for joining us. So does anyone have any other questions about rates, markets, buying a home, housing market? Anyone concerned about, prices dropping, any of that stuff? Anyone read any headlines that they want to talk about? Just go ahead and put them in the comments. Otherwise, Joy, is there anything that you would kind of leave everybody with as far as, comments and takeaways?
If it's a good time to buy a house, if you're ready for the long-term commitment and the investment, it's always a good time to buy a home.
Yeah. Yeah, and I definitely think if for anybody that has bought a home and, maybe when rates had been at the peak, we've talked about this, and I just like to touch on it each time we have one of these. Right now there's more homes on the market. Still inventory an issue, very tight, but there are more homes. There's less bidding wars. Homes are not going over crazy amounts over asking price. You may be able to get what's called a seller concession. Talk to a vetted professional. Google or search in the group, and you'll see what we talk about on those. But overall, it is a great time because there is that advantage. If you did buy a home over the last couple months and you were maybe rates that were much higher, you will have that opportunity to refinance. Remember, it does take a little bit of time for that. You need to make 6 monthly payments and wait 210 days to take advantage of a VA IRRRL. But if you have a VA mortgage, there's a very good chance that we'll see rates that are even better than where they're at today. So, stay in touch with your professional and they will help you when that time comes. Watch out. You're going to get inundated with a bunch of offers that look very official. The VA does not refinance your loan directly. Be careful of all the stuff you get in the mail. There's a lot of come-ons and a lot of advertising. So, but these are opportunities. If you buy a home now and you're like, hey, Hammer, maybe I should hold off buying a house. Rates, you say rates are going to get better. Why don't I wait until rates get better? You want to buy a home now when you still have those other current home buying advantages, because when rates go back down again, home prices are going to start to go back up again. Bidding wars are going to start again. Demand is going to bring all those problems with it. So, now's a great time to get your foot in the door. And when rates do fall, if they fall, again, I can't promise you they will, but there's very good reasons that we've shared why we think they will. That's when you can go ahead and take advantage of that IRRRL and, get yourself a better rate when that time comes. So, all right. Well, Joy, any last thoughts you want to leave everybody with?
Yeah, there was a comment. Rates were 7.5% when a Facebook user purchased a home. These rates are still okay. Yes, you can always refinance. That's true. You what is that saying? You date the rate, marry the house, divorce the rent, kind of thing, right?
Yeah, that was a big social thing.
Yeah. And then when homes are inflated, those that purchased went in the pandemic and they'd overbid. Yeah, that was a risk they took, and that's why we have appraisers to make sure there's fair market value. Thomas.
Yep. Thomas Sloan said, what's caused home prices to appreciate so much over the last 2 years? And is there a concern they'll go back to where they were before the pandemic? I'll let you go first. And then if there's anything I want to add, I'll add it.
Supply and demand, artificially low interest rates. Also people could work from home now. And so they could move to places where they, actually wanted to live. It was the perfect storm, right? Yeah. I am not concerned that it will go down prior to the pandemic. We still have a supply issue. The demand has cooled a little bit, but like Hammer said, when the interest rates go down, it will spur on the demand more. We have a lot of people on the sidelines that are scared, but Warren Buffett says, when everyone's fearful, that's when you need to take the time and the opportunity right in front of you. So, I mean, he's a little bit of a smart guy when it comes to finance. Go ahead, Hammer.
Was that the artificially low interest rates, not only did they drive the prices up, but they're also because people are not getting out of those loans. They're not selling those homes. That inventory is not hitting the market. Normally, when rates go up, we would see inventory rise, home prices would come down. We're not seeing that because even though, imagine it like this, we had 100 people to every home when rates were at 3%. Now we only have 50 people to every home when rates are at 6%, but it's still 50 people to every home. It's not one person to 50 homes. So we still have more demand than we have supply, and that's why you'll see rates will hold. Some markets, they are, definitely falling down a bit. Also, the asking prices, when you see articles, a lot of them talk about how asking prices have dropped. Well, it's because everyone always asks more than their neighbor. If Joy sells her house for $300,000, I ask $315,000. And well, maybe $315,000 isn't selling. Maybe Joy sold hers for $300,000. Maybe I only get $300,000, or maybe I get $295,000. Is that I'm not in a hurry to sell my house and I sell it for $250,000. So that's kind of a perspective. So, all right, y'all. Well,
in my market in El Paso, we have like a 1.5 month supply. And a healthy housing market is a 6 month supply,
yeah,
right?
Yeah.
So we still don't have a healthy housing market in that
Yeah,
sense.
Not even close. So remember, everybody, thanks for joining us. We appreciate you. You can join us next week. We do this 12 p.m. Eastern time every week. You can figure it out from there for your time zone. And we will see you next Wednesday. Take care, everybody.